Hello, clients and friends. This is Craig Llewellyn from U.S. Investors International. It's my pleasure to welcome you to our second quarter economic review here. Just wanted to give an overview of where we're at through the second quarter, June 30th, and just give you an overview of where we're at and kind of what we see as we go forward here. At our firm here, we partner with clients and believe in an educated client is the best client. Always advocated that. While we always try our best to help you when it comes to your finances, we believe that knowledge is power. One of our missions is to share with you any knowledge that can be better, that we can better help you to make an informed decision. So let's address the elephant in the room right up front here, or should we say the bear that's now here. Investors have seen multiple record highs over the last few years in the stock market. We knew at some point a market correction was inevitable. We've been talking about this the last 2 years. Somebody recently asked me, it's like, if you knew it was coming, why didn't we go to cash? As I responded to her then, and I'll respond now, if we'd have gone to cash or more defensive when I was most worried, that would have been 2 years ago, and we would have missed out on the best 2-year markets we've had in a long time. So there's no way to predict these things. We know when we get overdue for something, but what we did do is we were being very defensive the last 2 years, beefing up money markets, paying off homes and second homes, doing a lot of that, and being prepared for the next possible downturn when it came. So most people we beefed up money markets, beefed up your savings, and I think we're weathering this much better than we have in the past. The Dow Jones Industrial just registered its worst half of the year since 1962, and the S&P 500 had its worst first half drop since 1970. This type of market movement is unpleasant to watch and can make even the most patient investors uncomfortable. The brunt of that downturn was this quarter when the Dow ended down 11.3%, and the S&P 500 closed the quarter down 16.5%. Most of it coming late in the second quarter. This is a far cry from the bull market where investors were treated to equity markets that more than doubled between the March 2020 lows and until January of this year. As Warren Buffett said, the stock market is the device for transferring money from the impatient to the patient. It's key for investors to remember that equities are long-term investments, and any panic-driven impromptu moves that deviate from your plan could be costly. I've been saying that for the last two years, the last year to date. We need to be really patient here. It's going to take time to work these things out. This is more normal. This is uncomfortable, but not unusual. So let's review this quarter's bumpy ride. Second quarter continued this year's theme of heavy volatility, and the S&P 500 is officially in a bear market. The Federal Reserve raised interest rates by 0.75%. This is the biggest rate hike since 1994. Their narrative said we should expect additional rate hikes this year, which we've seen. They did it again in their last meeting. They're going to do at least that. We're expecting next week, if not a little more. Inflation is still an issue for consumers, and we've yet to see if the Fed's defense of raising rates will work to cause a retreat in the inflation rate. And indeed, what we've seen is the rate continue to go up here. The world continues to see unrest, particularly with the war in Ukraine. The war is still an issue. It hasn't gone away. And also, let's not forget about the COVID, especially in China, the second largest economy in the world, and the manufacturer of mass products still holds a zero COVID policy and can continue to have lockdowns that affect the supply chain at any moment. So in summary, this last quarter was an unrestful quarter. So this is a good time for investors to keep in mind that even though we have experienced a downturn, the S&P 500 is still well above the 2020 low caused by the pandemic. And so March of 2020 to April 2020, the market was off much worse than it is year to date. And it was the fastest recovery in history. So the media didn't have time to get their paws into you on that one. Here they have. The other thing that's important to know on this is it's not just been the stock market that's gone down year to date, it's also been the bond market. That conservative asset class has moved down as well. It's just a miniature 2009 all over again, where there's been no place to hide. Stocks are down, bonds are down. The cash and money markets, even though they're up more than what they were beginning of the year, they're still not paying much at all. It takes time for rising rates for those money market CD to catch up to that. As we mentioned, the S&P 500 is officially in a bear market. Bear markets are defined as when the market drops 20% below a previous high, and they are a normal part of the investment experience. There's nothing here we haven't seen before. The good news historically is they have lasted for significantly less time than the bull markets. So an interesting stat, bears last an average of 9.6 months, while bulls last an average of 2.7 years. A lot of people are asking me, I don't have 5 years. I know it'll come back, but I don't have 5 years. I don't have 10 years. I can tell you, teaching this in the college, many of you know I teach this 3 quarters a year, three semesters a year in the college. I teach an investment class. I've got all the Dow charts clear back to early 1900s. The worst one in terms of length was 1972 to 1975, 3 years. That said, there's a lot of similarities between then and now. There's some differences too. So, but I don't believe it'll take 5 or 10 years. It has not in the past, and we've seen some doozies of times. The long-term average frequency between bear markets is 3.6 years, which is interesting, right? So what we've seen here in the last 13 years, none of this has been normal. It took 11 years to see a next bear market. That wasn't normal at all. So what this means over time is an investor could see about 14 bear markets in a 15-year investment window. And since 1930, the market has been bearish for a total time period equal to 20.6 years. So this means that stocks have been on the rise the other 71.5 years. So many reports are saying the recessions usually follow bear markets. However, facts share that of the 26 recorded bear markets, a little more than half came with a recession. Recession can be a scary word, so let's talk about that. The actual definition of recession is defined by the National Bureau of Economic Research Business Cycle Dating Committee. They explain that a recession involves a significant decline in economic activity that is spread across the economy and lasts more than a few months. There's disparity there of how we define recessions. Some say 2 negative quarters in a row. The National Bureau of Economic Research says it's a few months. Bottom line is negative GDP is never good, especially consecutively. We have seen 1 quarter of negative GDP. Still unknown what the second quarter. We'll know that next week. If it's a second quarter GDP, and there's 2 quarters of negatives in a row, many economists believe that is defined as we're in a recession. We're really not sure here. I've heard both ways. I've heard it's going to come in positive. I've heard it's going to come in negative. So bottom line, though, is inflation's still high, and so the Feds are still in a rising rate environment. And it's important to remember that these markets are still way above the pandemic-driven declines that we had in 2020. While possible, numerous experts believe we will not see a recession in the near future. There is a cause for concern, and we're keeping a very close eye on the economic environment indicators of recession. So the way things are going right now, we very well could be headed to a recession. I'm not convinced we're there yet, but we could as we move into next year. I don't want to get too far out here. Right now, what we do know is interest rates are on the rise. We need to be really patient here. So as the stock market comes back, and we believe it'll continue to recover here a bit through the end of the year. Historically, when it's had its tough year like this year to date, the second half tends to be strong. We think it will, minus another geopolitical event out there that we don't see. But that's not going to be without its volatility. We know historically when rates rise, markets tend to have more volatility. So we think they'll go up from here for a while through the end of the year, but it's going to be slow and it's going to be volatile. And then, also understand too, that even if we do go into a recession, that does not mean we're going into, that investors are going to get wiped out. It doesn't mean we're going into another Great Depression. Even in the Great Recession back in 2008 and 9, there's a lot of differences between 1929, 1930, and today. One of the major ones is the central banks. We didn't have the central banks around the world like we do today. So we could at any time see a recession like we saw in 08 and 09, or any other type, or even a mild recession. There's always a 23% chance in any given year that we could have a recession. And even though there's not there's no established formal inflation target, the Federal Reserve generally believes that an approximate 2% rate of inflation is acceptable. The annual inflation rate for the US was 8.6% through May, and then we just got the reading here last week or 2 weeks ago that it was at 9, so well over 9.6% now. And where are we seeing this the most? Well, we see inflation in gas prices, we see it in the grocery store, we see it in house prices, and all those saw heavy increases last year. A lot of them seen them year to date. However, two things to remember here. The CPI, the way the Feds track inflation, does not include food and energy. They took that out back in the early 80s. So that's a major difference between now and the 70s. And the other thing that's interesting with inflation moving up, one of the surprises, with interest rates moving up, and one of the surprises at the beginning of the year was when the mortgage rates doubled in a 2-week period. That's a major move for mortgage interest rates. We're now beginning to see that nationwide, and it's picking up here in the Northwest. Prices are beginning to fall fairly, I wouldn't say hard, but quickly. We're seeing more supply come on the market. We are seeing prices go down. We just looked at our own area last night. People are adjusting prices downward. I find this very interesting. We think real estate's going to continue to have a harder time as we move into the next few months as rates continue to rise. How can it not? So as I've said before, if you're a buyer of real estate, be very, very patient here. Don't be in a rush. The interest rates movement of the Feds are on your side. If you're a seller of real estate, we've been telling you that all last year, get it done, get it done. Things are changing now. So be looking at that, in terms of selling real estate versus not. It may be too late now. You want to look at that. You want to look at your market and kind of look at your time frame. Might need to go through this next cycle. So, standing by its commitment to fight inflation, and the Federal Reserve on June 15th again raised the rates by 0.75 points. And again, it's the biggest single rate hike since 1994. And add that to the 0.75 increase already implemented earlier this year, it brings the federal funds rates to a target of 1.5 to 1.75. Wall Street responded with sell-offs, taking the S&P 500 officially into a bear market in late June, and the Dow Jones dropped below 30,000 for the first time since January 2021. What's interesting here, though, there's two things. First of all, the Dow, 20% more down being in a bear market, the Dow has yet to reach that number, which I think is fascinating. It's come close, but it hasn't reached that number. The NASDAQ and the S&P 500 are in bear market territory. So I think part of that could be the energy. Energy has been the one thing that's been strong year to date, and that could be helping the Dow go in from that bear market territory. But if we are headed for a recession, even energy, nothing, recessions, nothing tends to be sacred in those recessions. And the other interesting thing here is we know that the Feds have said that they're targeting 3.4% on the Fed funds rate by the end of the year. So we're talking a pretty significant increase still to go here. So again, a lot of you have locked in money on CDs. I really, really, really tell you, don't do that. Um, this is the wrong time to lock in money. The only thing we know for sure right now is the Federal Reserve is raising rates. Don't lock in money while the Feds are raising rates. We want to wait and be patient on that. And when you see the rates, and this is a little outdated, the rates have moved up a bit more here from this, but people are looking at CDs, 1 year, 3 year, 5 year. They look a lot more attractive than they did a year ago, but rates are still on the rise. Don't lock in money in anything. We want to wait until the Feds come out more of a neutral stance, or they start talking about lowering rates. That's when we'll start looking at not only CDs and money markets, but the bond market will be on sale at that point. So, and part of the bond markets today, especially the tax-free bonds, look very attractive. So we think as we move down the road here and the rates continue to rise, it'll be easier to put money to work and or to become more conservative later on this year into next year. We also think right now equities, I think we'll see a little more positive direction in equities. It's showing some good signs here in the last couple of weeks. But again, it's always vulnerable to geopolitical events. But these low rates, and this is the other problem year to date, is money markets and CDs. There's just been nowhere to hide year to date. We also feel that volatility is not going to go away. I've been talking about this with rising rates. Volatility is here to stay. So in the coming months, you need to be prepared. We're going to see more volatility. And remember, if you have a well-diversified long-term financial plan, we do not want to abandon ship. It's not in your best interest. I've had one person that's sold out, didn't want to hear it. I tell you, we've seen worse markets. We've been more worried in the past. There's nothing here we haven't seen before. It's uncomfortable, but not uncommon. This is more normal. The last 2 years haven't been normal. And it's going to take time because both the stock and the bond market have come off this year. So with interest rates rising, the equities, I think, will probably show a little more life here than the bonds will. But I think next year we could see bonds, depending on when the Feds get done raising rates. We don't know when that is yet, but that's when we want to look at that more conservative asset class, look at the yields at that, and maybe lock in. We'll see. Being knowledgeable of the cycle of emotional investing is always wise. Really look at this chart and feel where you're at. And remember 08 and 09. There was a gal I talked to the last couple of days. She didn't remember being this scared at all. It's like, I have all the notes. Yeah, you were. You were worse scared back then. And so this is a theory everybody should understand. I've been really harping on it the last few years, knowing that we'll have another recession, at some point, or bear market. But people forget. I just had another phone call this morning. People forget the bad times. When things are good, we don't want to remember the bad or think it's going to happen again. And one thing I want to do as we go into the next 18 to 24 months, as we come through this thing, I want people to remember the bad times, because when it gets good, that's when we want to rebalance. And if you want to change your risk level, that's what we want to do when markets are good, not when they're bad like this. If we do it now, we'll never recover, or it'll take a lot longer time to recover than if we just got to stay put here and ride this through. The current market environment is most certainly testing the discipline of investors. Some investors panic and jump ship during these times, like I was just saying, while others choose to ride it out and wait for calmer waters. What mindset do you have? Look where you're at on this. If you are in a panic or a defeated position, this is the time, depending on where you're at in your growth stage or your retirement stage. If you're in a growth stage, when you feel defeated and panicked, get your checkbook out, start getting more money in your investments. And the rest of us need to sit tight and just wait this through. This is a normal part in the investment process. And having a comprehensive financial plan takes into consideration how it react to each cycle before it happens. This helps you make the best non-emotional decision, non-hasty decisions for your hard-earned money. We want you to make money. And if you bail out during these times, we'll all lose. So let's review the outlook for the upcoming months. In the approaching months, we expect to see more interest rate hikes from the Feds. The cost of loans are going higher, most notably in mortgage rates. If you plan on any large interest-bearing purchase, you may want to consider having liquidity for any purchases. And be careful. Rates are much higher than they were 6 months ago. And as we mentioned earlier, there are still many variables like geopolitical unrest and continuing health concerns that could affect the speed and direction of the economy. We're keeping a very watchful eye. We're watching very closely on changes that may affect your situation. The interest rates going up like they are as quickly as they are is a major game changer. Different things are going to look attractive as we move down the road into next year. Again, we're watching this very carefully. Here's some things we feel would be beneficial to do in light of the rising interest rate environment we're in. Review all of your income producing investments, which we've been doing with everybody the last couple of years, beefing up money markets, being ready for this. If things went down, we can just ride through it. And buying this time that, when we look at income producing stuff, if you need income out of your portfolios, we want to buy time to let the markets go down and rebound. We always like to take profits and build up money markets. We don't like to take losses. If you haven't locked in your mortgage rates or consider refinancing at this point, you may have missed that opportunity depending on where your old rates are. It's amazing, right? 30-year mortgages, people were locking in those rates at 2.5% in December, and they're well over 5% today. Just confirm your cash flow needs. Let's make sure you have enough cash flow. We've been working on that pretty hard the last year. While markets were strong, I feel pretty confident as I've been doing the reviews so far year to date. Things are working the way they should be working for us. I think things are looking pretty good. And then we've also been in our reviews looking at a full review of your people's plans, of your financial plans, your long-term objectives. If you're not using this money, if you're using this money, we beat up your money markets. If you're not using this money, we just have to wait this through. There's good times and bad times. It's called average annual returns. And if we try to time the market where we get scared and go out again, I would have had you out 2 years ago. We know historically and from our own experience, it doesn't work. We know that when it decides to recover, that first 30 and 60 days is the most critical part of that recovery process. And if we're out in the market on that, it can take much, much longer. It can take years more to recover. And the last few years have reminded us that anything can happen. That's why we always abided by our mantra. We want to always proceed with caution. As markets have been high like this, we know that we were overdue for something. And I was telling somebody this morning, when we get into this period that goes for 2 years and we don't even see a market correction defined as 10% or more to the downside, when we do get that next correction, and then there's a geopolitical event with it, this is what we get, is this shabam. It's ugly. Again, we've seen all this before. There's nothing here we haven't seen. But they're challenging times for investors, and we want you to be comfortable knowing that we're staying appraised of any situations that may affect you. We're having a proactive approach to your financial goals and a solid investment strategy as part of the holistic offerings we provide you. We have all good quality. We're all well diversified. We will make it through this just like we always have. And as always, if you've got other people, friends, or people you work with that can benefit from these videos, from our newsletters, we have a newsletter that you should have received here last week. Now you're getting this this week. If other people are nervous or scared, share their names and their mailing address with us, and we'll make sure, and their emails with us, and we'll make sure they're getting the same correspondence that you're getting. We appreciate you, and we want you to be able to add names to our distribution list to receive this information. We hope you take advantage of this and add a couple of names to our list. And it's also how we grow, and we appreciate it very much. And other than that, again, one of our goals for 2022 is to continue to help other people. Some of our best clients were referred to us by existing people. So please feel comfortable letting us know the names of anyone who you feel could benefit from any of this information or our services. Again, our workshops, we'll have more of those coming up. Again, one of our primary goals is to keep clients informed, and we appreciate you watching this update. Please call us with any questions. And I hope you're having a great summer. It's finally arrived. It's hot, but I hope you're having a super day as well.